Hello, and thank you once again for taking the time to check out this brief video. Today we are going to talk about one of the warning signs that we saw back in 2008 that was flashing red that would have queued us up to potentially know that some sort of a market correction or crash was headed our way during that time frame. We are currently experiencing something that might be similar to that in today's marketplace. Specifically, what I want to talk about today is something to do with yields on bonds. A yield on a bond is simply the interest rate that you earn as an investor on a bond if you loan money to a financial institution or business or government. So, first of all, I want to spend a little bit of time thanking you for checking out this video. Second, I want to get into all the details as to how this might be something that you could watch for and be a very action-oriented step that you might be able to change in your own current investment mix and potentially help yourself either now or down the road. So, without further delay, let's start by just explaining what we mean. And what we mean by a yield inversion is simply the idea that at times in the market, the investing market, there are situations where longer duration bonds can pay us less as an investor than shorter duration bonds. Okay? So, to put a little bit of context around this, if you have a 10-year bond, that means that you are willing to lock your money up for 10 years. And let's just hypothetically say that that bond is paying 2.75%. Okay. If we see a 1-year bond or a 3-year bond that would be paying us 2.75% or higher, that would mean that those yields have inverted, meaning you are not being rewarded whatsoever for purchasing a 10-year bond and locking your money up for that additional 9 years of sticking your money with that financial institution. So, what does this mean to you? This simply means that there is reason to believe that you might be better off owning a duration bond or a bond that pays you a more fair rate of return based upon the amount of time you're willing to lock your money up. This can be difficult to understand when I'm talking about bonds. What I want to do today in this video is make it very simple and easy to understand. So I want to relate this back to something that we all know, which is a certificate of deposit or a CD. If you go into a bank or I go into a bank and I ask the teller, hey, what are your rates on your CDs? Most of the time, if not all of the time, you're going to experience your 5-year, your 7-year, your 10-year CDs are going to pay you a substantial amount more money than what you would be paid for a 3-month or a 6-month or a 1-year or a 3-year CD. Obviously, they're going to pay you that because they know that they have to do that to entice you to leave your money there for longer. The investment community, the investment world, the mutual fund world, the bond world, all kind of synonymous, should, under normal conditions, function the same way. Okay? Typically, you are going to be paid more in interest each year that you own a longer duration maturity versus a shorter duration maturity because obviously you're locking your money up for a longer time period. Okay, what we are experiencing today is those yields have or are currently close to inverting. So you are not being paid, a lot of times you're not being paid an appropriate or a fair rate of return for locking your money up for longer. Off the cuff, this probably seems like it's not that big of a deal, and off the cuff, it probably isn't. However, if we would experience any sort of a market correction, or we would experience interest rates continuing to change, this will or could have a fairly big impact on what you have invested in those type of bond instruments or investments. In other words, if you own a 10-year bond and rates go up or down, you are going to be much more impacted by that rate move than if you own a 1-year bond. So what this means for you and I as investors is that we should carefully look at some of the things that we own currently in our investment mix and make sure that we truly are being rewarded for the risks that we're taking. Okay, if you are investing in an age-based portfolio, some of those money managers are constrained by their prospectus to own a certain duration bond fund. Okay, so sometimes, and this isn't bad, but sometimes these age-based portfolios are required to own 7 to 10-year bonds, or maybe even longer duration bonds. And that is very common, and there's really not a problem with that. It allows us to be able to predict and to see, to forecast how we plan around certain instruments or certain investments in the investment world. However, there are also times when we know that as consumers, sometimes if we get lumped in with a herd, that those decisions that are made by the herd might not be the best decisions for you and I as consumers. That's why I wanted to make this video. Was sometimes we're going to be in a situation like today where we own this age-based fund, but if we really looked at the facts of the case, we probably have other things available to us that we could invest in. And if we wanted to, we could shift out of maybe a 10-year bond or an age-based fund and shift into something else that might be more appropriate and reward us more for the time frame that we actually wanted to invest our money. So, meaning we might want to shift some of our ownership of bonds into shorter duration bond funds. Now, this is not always the case, but it is something that is worth considering. And the primary reason is due to the fact that there are impacts on your money by interest rate moves. And we've done other videos that get into this in great detail. But just so you know, there is, 99 times out of 100, an inverse relationship between interest rates and bonds, bond prices. As interest rates go up, bond prices go down. The Fed, the Federal Reserve, in other words, our central bank in the United States, is currently stating, and they have already many times over the course of the last few years, raised interest rates. And as they're stating, they are planning to eventually continue raising interest rates. So what that means for us as consumers is that we might want to take a little bit of action based upon these facts and just review what the duration of the bonds that we own are and make sure that they are fitting with the risk and the expectations that we have as consumers and investors. If you have any questions, please reach out to us. Hopefully we have given you something in this video that you will be able to act upon and make some money moves and hopefully protect a little bit more of your wealth. Thanks for checking out the video, and we look forward to talking with you soon.